The following podcast is produced by Total Money Management. Everything you're about to hear is general information and education only. It does not take into account your personal objectives, financial situation, or needs, and it is not financial advice.
Welcome back to Total Money Management, Signal and Noise, weekending 17th of July. That was a game of roulette.
For the second time from an undisclosed location, because the first time we did it, we snafu'd it.
What happened last time, Steve?
One of the mics didn't work.
Yeah. Well, hey, you leave me in charge, you get everything you deserve.
That's right. He's in the stock game, not the tech game.
You live and learn.
Thank you, Tom.
That's right. 2 out of 3 of us. Have you listened to the recording from last week? It's me and Tom, and then just
that would be
minutes.
Very unintelligent.
And then just silence.
Just the dumb bits.
Yeah, just the jokes.
I'm glad we didn't release that.
Oh dear. Well, it could be worse. You could be a pom.
Oh, I asked you not to say anything.
Broken-hearted, mate. Broken-hearted. What? I didn't watch it, but I was following the score. How far in were England 1-0?
You're gonna make me relive it.
Yeah. Like 60 minutes, 65.
Yeah, we were leading for I think 75 minutes.
Oh man, that's painful.
Yeah, and then we copped one at 1-1. Honestly, we could do an hour podcast on how pissed off I am at England.
Yeah,
so
we might look at that next week.
Steve looks very sincere.
Yeah, so I'm sad. I've been a sad boy all day.
All right.
What do we got, lads?
Well,
what do we got?
Look, we've got some brief notes here. War expectations.
Yes.
Didn't you?
What are we talking about?
We're all going to die.
Yeah.
Well, remember we said the MOU is fibs, right? They wrote the MOU and everything was like in Iran's favor.
Mm-hmm.
And it was obvious that it wasn't going to last.
Yeah, we're going to open the strait. We'll be friends.
Yeah, we'll give you everything. We'll give you money. Oh, yeah, we'll give you bombs. Yeah, lovely. And then they went, yeah, nah. Okay, now we're going to bomb you again.
That's right.
So we're back to square one. And I think the problem is that we are going to have more problems going forward because when we first started the war, there was like the strategic petroleum reserve had, like 600 million barrels, right? Well, now this time around, it's got like 400 and it's getting lower. Mm-hmm. So there's
So there's actually a risk of a genuine shortage, whereas last time it seemed like we were in the clear.
I think the problem is, Tom, when you say oil, people just go, oh, oil. And it's not as simple as that, right?
Heavy, light.
Yeah, there's jet fuel, there's diesel, there's heavy crude, there's sour light, there's mid-strength, right? So it's really important because...
Like the local brewery.
Yeah, super dry.
But it is. It is. And this is why I say with commodities, people are just like, oh, iron ore is iron ore. And it's like, nah, it's a little more sophisticated than that, right? Yeah. And so it's the same with oil. It's the same with wheat. All of those commodities have always been thought of as being like, if a country does commodities, they're obviously poor, right? Because they're not making dishwashers. But the thing about that is that was the way it was for quite a while. But when you look at commodities now, what they've done is like a dishwasher, right? It's become more sophisticated and it's got digital and it do all this stuff. Well, it's the same with oil and commodities, right?
Yeah.
They've found different uses for oil, right? And that created a market for it. So it's no longer just like, oh yeah, you pulled out of the ground and, you put it into a car.
Well, there's like 3 major sectors that, like, the way I view it. You've got the huge Western countries that have big finance and tech sectors. You got Wall Street, you got London Exchange, all those big countries. And then you've got everyone else, which is basically commodities in Australia.
A little bit, emerging markets.
Yeah, emerging markets in Australia where you've got everyone just pumps stuff, digs stuff out the ground and exports it to whoever. It was interesting. On the episode we didn't release.
Right.
I was talking about the little Strait of Hormuz tracker that I've been
yeah.
And when we recorded it last week, there was, I think, 25 ships a day going through, which is 35 less than the last 60 days.
Yep.
Which is about half the amount of...
They're normally 120,
Correct. It's up to about 41 now, so it's still well under.
So they're flowing.
Yeah, well, it's almost double where it was last week, but half to where it should be. So it's just interesting to a lot of the ships that are waiting are huge, kind of wheat and oil containers as well.
Yep.
And I think the point I made last week, which didn't obviously go to air, was it feels like we're creeping toward this point in time where we might hit a supply shock. And we've been talking about it for ages, but it hasn't really come.
Not yet.
Or at least the media hasn't publicized it.
No, you're right there. The thing that surprised everybody last time was the drop-off in China's imports. That's what really took the supply down, right? And that's why they were going, where was the disaster?
Yeah.
The disaster was avoided because China dropped imports, right? And used a lot of its own. And that's where the demand destruction came in.
It was right? suppressed by using their own reserves.
That's right. Yeah. So rather than saying we still need 100 million barrels a day, they went, oh, actually, we only need 90. So we're generally a bit more covered.
Yeah.
But what's happened now this week is some of the big carriers have said we're not going through there, even with American, military support.
Just too high risk, or
well, yeah, Tom, it says too high risk.
From an insurance.
Yeah, I wouldn't want to be one of the blokes on the boats.
No, absolutely. I mean, you know, they're not paid that much. You know what I mean?
Is it the insurance?
The insurers are also saying, well, you know, yeah, you can sail through, and it's $100 million a ship, right? I think insurance went from, I might be getting this mixed up. It might have been containers, but something went from like 1,000 to 7,000, right? Like a sevenfold jump. And it's because of the risk, right? And the uncertainty around it is just enormous, right? Because, you know, 30 days ago, everyone was going, cool, great. You know, Brent and West Texas Intermediate's gone from 110 to 65. Now it's back to 83, I think, or something.
I was it was classic. I was rebalancing on the way down, going, it's still cheap.
Yep.
Still, like, the logic tells me that there's a supply shock, there's no ships going through. So I was rebalancing, going, should have just sold it $100.
Yeah, I know, but
and now it's gone up again. Oh, yeah,
that's
cool.
That's what I mean. But see, Jacob, you think about that as a financial planner, right?
Yeah.
An accountant, a company financial officer, and what you're trying to do is project out, hey, you know, Billy, oil next 12 months. What do you think, mate? Normally you can go, oh yeah, it'll be between, you know, 40 and 60, right? But now you go, yeah, probably between, say, I don't know, 70 and 150. And it's like, well, hang on, how can we plan profit margins and all sorts of stuff, right? Oh, and in fact, we might not have any oil, right? I mean, it really, this is part of the problem, which is that now that global trade's breaking down, you're getting this disruption.
Yeah.
Right. And it's gonna be with us for 5 or 10 years at least.
Well, that's why I like to look at, like, I know we have a laugh about it, but why I look at the ships going through, because that's a real life number.
Absolutely.
And you can go, okay, it's usually 120. We're currently at 40. That's a red flag. We've been at 40 or 20 for like 3 months now.
Yep.
So, like, that's why I'm a little bit more confident to invest more in something like oil or just commodities in general, because until that number goes up to 100 or actually in surplus up to 150, 160 and more,
still challenged.
Then supply is going to be a challenge. We know it lags. So
that's what I mean. These things, it's like we said a few weeks ago about bankruptcy, right? Slowly and then all at once.
Yeah.
Right? And this is the problem we've got. When you've got this level of change and transition going on, it's really hard to plan, right? And it's really hard to predict. That means you've got to do heaps of hedging. And what does that mean? That means it comes off your profit margin, right? Well, that means then that you've got to look at your CapEx budget, right? That means you actually should say, okay, well, you know, we might need to stack up on something, right, to keep some inventory. but there's you and 5 other guys in the industry doing the same thing. So, you know, you want to keep more in store, but so does everybody else.
Yeah.
So what happens? The price shoots up, right? Because it's a disorderly way of trying to get everybody's out there trying to do the best they can, but what they're doing is forcing up the prices.
Yeah.
Right, with inflation and you're getting shortages and stuff.
Yeah, I mean, and all the while you've got something like the Korean stock exchange booming.
Yeah,
because it's all semiconductors and kind of AI chip stocks, and that's just been as volatile over the last week anyway.
It's been nutty.
Yeah,
we're doing this on Thursday. I think it was.
Yeah, Monday it dropped almost 9%.
Yep.
Then there was 5% of intraday volatility on the Tuesday. It closed up.
Yep.
0.73.
Then I think just on that, Tom, I think on that day they actually halted.
Oh, really?
Yeah. And I think the Korean, might have been the prime minister or president, I'm not sure, came out and went, the stock market's really unstable.
Mm-hmm.
Right. And then what happened from there, Tom?
It went up 6.24% on Wednesday. And then it dropped again 6.4% thereabouts
today.
Yeah.
Yeah. See, you know, you look at that, that's unbelievable volatility.
Yeah, it's
right.
Insane.
And so that's where you look at it, and inexperienced investors have this complete fluctuation from fear to greed. Right? It goes up 8%, you think it's fantastic, and then the next day you lose it all. Then you start to panic. Then it goes back up again, right? Then you lose it all, right?
Well, it's the concentration of this Korean stock market, and we'll talk about the percentage of like a semiconductor stock in the S&P.
Yeah, yeah.
But if you think about the Korean stock market, the concentration of semiconductor stocks would be like 80%.
Yeah, it's huge.
So like everything, talk about diversification.
Yeah.
There is none in that stock market.
Essentially no. Yeah. That's because like the Koreans basically sort of copied, like a lot of Asian economies, they copied the Japanese model, development model,
right?
Which was the Japanese have the keiretsus, which is basically the same as conglomerates, right? What the Americans call conglomerates.
Yeah.
And the Koreans call it chaebols, right? So they have 4 or 5 companies that are mega enormous, and they basically do all the importing and exporting. Right. So they're like thing in the Korean economy where it was like they were like 85% of the Korean economy or something. Right. Wow. Like it was just enormous. And but like you say, Jacob, when you look at the stock market, right? Well, now I'm not doing this off the top of my head. I checked. What's the Korean Cape? Without looking, Tom.
Okay, I'm going to guess it's 37.
Jacob?
48.
44.
Oh.
Now, it's gone from, in the last 12 months, it was, don't quote me on this, December 24, it was 17. Okay, so that's, fair value. Mm-hmm. Then the next quarter, it went to 21.
Hang on, when was it 17?
December 24.
Oh, wow.
Yeah. Because remember, we had it in well too when it made 100%. So it went from 17 to 21 in a quarter. Then it went from 21 to 25. Then it went from 25, I think, to 31. So at the start of this year, it was 31. Now it's 44.
Okay.
Right. Yeah. So that's where it's really valuable, because if you've made a lot of money, you go, okay, I think it's time to take my money. And, if you look at the other end, you've got Indonesia on 10, Brazil at 10.5, and Turkey at 10.5.
Yeah, I know where I'll be
right. So
moving to.
You know where you want to put your money, right? Now, Indonesia's had 3 down years in a row. It's super cheap, and the Cape ratio's on 10. You look at that and go, well, that's a better bet than having, Korea at 44.
Yeah.
Right?
Yeah. And then especially when you've got all this noise now around AI stocks potentially not living up to expectations, and not living up to expectations, but costing too much and not hitting their revenue targets and things like that. I think IBM dropped 25%.
In a day.
Today, whatever day it was.
Funny point on that. Because you remember I think we said a few months ago, remember Buffett bought into IBM?
Yes.
And everyone was like, oh, Buffett's bought a new stock. What is it? And he gave them a hint on CBNC and he said HAL, right? And everyone's like, HAL, what's he mean? What's he mean by HAL? And of course, HAL was the computer in the movie Space Odyssey 2000 or something.
Yeah. Oh, yeah, it's so obvious.
Yeah, a bit like that. So anyway, Buffett buys in and I thought, oh, I'll just go and check. And he bought in at about 170, right? Roughly. And when he sold at about 140, 150.
Right. So he took a bath.
Now it dropped 25%, but now it's at about 210. So if he'd have held on, he'd have actually made money.
Was that his first losing trade ever?
No. Oh, no. Buffett's lost heaps of times.
Okay.
He lost a mozza in COVID because he bought airlines just before COVID. But the same thing, Tom, right? He dumped the airlines during COVID and then like a year later, they'd all bounce back, right? So if he'd have hung on, he'd have actually made money.
And all the young people would be going, he doesn't know what he's doing.
Yeah.
This time it's different.
But I mean,
value investing's dead.
He sticks to his rules though, right? That's what he's got clear-cut rules. He sticks to them.
Absolutely.
It doesn't matter what the outcome is.
Yeah.
Well,
you can't look at any of those in isolation.
No.
You got to look at it and go, the guy knows what he's doing. But I just thought it was interesting because I thought, I should go and check and see how it's gone after that. Anyway. But
so semiconductor stocks now account for 20% of the S&P 500.
How crazy is that?
Not as crazy as I'm still kicking myself that I sold Micron as quickly as I did when you recommended it. I think it might have been.
Is that Micron?
20.
Yeah.
20. Oh, no.
14?
2019.
No, it was earlier than that, Tom, wasn't it?
Actually, I think it was before I had my son. Yeah. It might have been like 2017.
Yeah, it might have been. Yeah, I think it was earlier than that.
We're just witnessing Tom realizing he could have been a millionaire.
That's what I mean.
I had about 73 cents to my name at that point.
But, excuse me, that's the way it works, right? I sold out of Micron and if I remember correctly, I think I made 30% or something.
But, it would have been like 900.
Now it'd be like 4 million.
Yeah.
Right. But that's just, like you said before, Jacob, if you've got a system and it works, I look at it and just go, sure, there'll be heaps of those.
Yeah.
That's the way it works.
Yeah.
But when, semiconductors at 20% of the whole S&P is seriously overvalued. That's why we said socks.
Socks, yeah. Red socks. Long socks.
Short socks. Short socks.
Inside joke for everyone that's listened to every single episode.
Yeah.
For the last 6 weeks.
Really funny one as well.
All right. So what else have we got? Earnings.
Mm-hmm.
The earnings are getting, from what I can see anyway, the earnings expectations are that it will grow 24% next year. I reckon again, I don't reckon, I know, it's all based on AI and semiconductors, right? And at some point, that's not going to come true.
I was listening to a video that, Mark Cuban, the billionaire.
Yeah.
He came out, he was on someone else's podcast and said, one reason they're not going to hit their earnings potential is the ability for the data centers to basically get quicker will mean that it uses less. So they've said they're going to build all these $1 trillion data centers.
Yep.
The ability to do that will get a lot quicker, which means that they won't hit their earnings yields because I'm not really doing it justice, but essentially everything will get faster and cheaper quicker than what we expect. So I just thought it was an interesting take that he's not necessarily saying that AI won't achieve what it has set out to achieve, but they've expected it to take longer and cost more, and therefore the output would be greater.
I just don't understand how it makes money. Like they got to spend.
Nobody does.
They got to spend so much.
You're not the only one, brother.
And with all the memory shortages, like all that kit is getting way more expensive.
This is why I'm saying it's, it seems unreal, right? Because what we're doing is say, well, surely these, we're talking Google and Amazon and, Meta. I mean, these guys are all multi-billionaires. Surely they know what they're doing. But I can tell you, like when you read the disconfirming evidence, it's hard to shift, right? And the revenue projections, I saw one today where I think it was OpenAI are generating, I think it was, they said they would generate, that's right. They said they'd generate about 5.5 billion in ads, right? Revenue from ads in AI.
I've never seen an ad on
Well,
ChatGPT.
they came out and said, actually, the revenue that they've generated is actually about $1 billion. Now, they say, OpenAI said, Altman said, revenue will go from ads, will go from this year, 2 billion, to in 2030 to 102 billion, right? Now, that is clearly BS, right? That is clearly not going to happen, right? And this is the problem that
these God complexes, they can just say shit.
Mate, I was saying to someone today, shout out to Tony, who I had coffee with today from Melbourne. Elon Musk, honestly, could come out and say, look, I got to square it away. I'm actually God. And I'm sure people would go, I knew it, right? Because he came out last week, I think, and said something like, SpaceX is going to be worth more than everything on Earth. I mean, what idiot says that?
Well,
I mean, clearly you'd say, Elon, you need to stop taking drugs.
That's so funny.
Right?
It takes a fair few.
But, this is a guy who has never delivered on all of those predictions, right? Robo-taxi, nah. Self-driving, nah. SpaceX, nah. Data centers in space, nah. Right? He just misses every single time. And yet everyone keeps cutting him slack and making him even richer.
Yeah. Well, right? he's the talking head that everyone follows. So people are just investing in him, not necessarily everything else.
Yeah. So the thing that concerns me is when you look at the earnings projections, they are so unrealistic, right? Yeah. And there's no way to justify it, right? There's no way to say, oh, well, the money will come from, private sector spending on AI. Okay, well, if they do that, then we're either going to have an explosion in loans or they're going to cut money from somewhere else. Yeah. Well, we now know that AI is not displacing jobs. We know that the revenue's not there. We know the profitability's not there, and we know the return on investment's not there. So it's like, guys, what are we looking at here?
Yeah, I was talking to recruiters today who, just in general, and I asked them, I was like, what's the market like with AI? And they're like, it's interesting because we're actually hiring for more people to check the AI.
Yeah.
So businesses are using it and adopting it because boards and C-suite are basically forced to, and all their circles are saying how good it is. And then they're having to hire a second or third person to check
all the work.
Yeah. So so the recruiters are loving it and booming because there's all these AI specialists that they're recruiting for.
See, the thing that strikes me as really weird is it's only with technology. You think about software, right? And like Microsoft Word, all that stuff, the internet, all that sort of stuff, right? If you put out a product that was like AI, where it's about 80% accurate, right? Because it hallucinates and all this sort of stuff, right? Okay, so you imagine any other product where you said, Tom, your computer will work 80% of the time. And it's like, okay, well, I need it to work 100% of the time. And in actual fact, Tom, it'll be working, but it won't be giving you what you need. And it's like, oh, okay.
It's one of those things, right? Like you interact with it and you can see it will do the bulk of it, but you really do need to hold it accountable.
Yeah.
It's funny. This is so irrelevant, so I'll keep it brief. I was talking to a buddy who's in software.
Yep.
And he used it to respond to a tender. And he's like, hang on a second, where did you get the answers for this? And it's like, well, just based on like what most companies do for this stuff.
Yep.
It's just like, are you kidding me?
It's just
like,
making it up. Right. This is what I mean. When you look at it, I was talking to someone else today and saying, how do you think you could possibly get an asset bubble in tulips, right? In flowers?
Because human psychology
I know, but
really doesn't change that much.
But do you know what I mean? Like, if someone said to me, there's a land bubble, my argument would be, well, fair enough, because there might be, a population boom, or, like, you could probably at least rationalize it. But if someone said, oh, yeah, there's a bubble in tulips, and it's like, okay, what do you do with tulips? It's like, well, nothing.
Yeah.
Right? You just put them you just put them in a vase.
That's like Bitcoin.
Okay, but how do you get your money back on them? Oh,
Sell them.
You don't, right?
Yeah,
I mean, you look at it and go, that's nuts.
Yeah.
Right? And that's what I feel like AI is like. It looks like it's useful. And as I said before, no doubt in the next 10 or 20 years, it will be useful. But we are so far from that. And the cost of it is insane.
But not the cost to the consumer.
Like, but that's been subsidized, Tom.
Yeah, how? Why?
Because the companies are losing money. That's the problem.
Yeah, that's what I mean. That's what I don't understand. Because for us to engage with it,
yes,
really.
But but that's what I'm saying. Like, you see, what the company is doing is saying, well, look, Tom, we'll let you have Claude for $30 a month.
Mm-hmm.
Now, Ed Zitron has shown that it costs them, you can run up a bill of $14,000 and you're paying $30. Right, but it's costing the company 14 grand.
Oh,
but what they're doing is it's like, and it's a fairly standard business model. Lose money, but get people used to the product, get them hooked on the product, get them to see the benefit, right? The ROI, the return on investment, and then Tom says, okay, yeah, between them cost reduction and you going, yeah, I couldn't live without this Claude, I'll pay $80 a week or something, right? That's where it meets.
Okay, so it'll do a Netflix to us where it started us at $10 a month,
exactly,
and somehow we're now at $40 a month.
Tom, 100%.
Yeah,
right. But the problem is, what they find is there's a huge churn rate, and the churn rate is about what do they call it? Where you stop, like you use it and then you go, yeah, nah, quit.
Or I'll take the free 5 weeks.
Yeah.
Then I'll
it's like gaming, right? They get you to play the game. You play it for a month and they go, yeah, nah, I'm over it. So you don't subscribe anymore, right? And that's what's now happening with AI.
Yeah, and people are trying different ones.
Absolutely. Well, see, again, there's no moat. Right. Yeah. So you can go, oh, well, I'll use Claude, I'll use Grok, or, I'll use the other one. Right. And that's part of the problem.
Yeah.
Because they're all trying to compete, but it's a really capital heavy industry. Right. Data centers cost billions. Right. The chips are cost billions and you've got to upgrade them every 2 or 3 years.
But not only that, since late last year, all that data center stuff has over doubled.
Yeah, absolutely.
Yeah. So that's what I mean. And it seems to keep going up. Because supply is challenged for the chips and the memory and the bits and pieces that go in them. So
that's what I'm saying to people.
It's a death spiral.
It's going to be the source. I don't know what happens, but it's going to be the catalyst for trouble, right? Because we're all going to wake up one day and go, they're not going to make those earnings targets. They're not, at some point the big investor says, Tom, you've got to show me a path to profitability. And if you can't, that's when they say, okay, dude, no more money.
I can't help but feel it's going to be the first big hedge fund to sell. Like, we'll kind of lead the way there.
Yeah.
Like the first one out.
Yeah. Or a bank.
Yeah.
Something like that.
Well, there just needs to be an IBM, like another IBM, where they go, actually, we projected 10 bill and we've done 5. And then there's a 25% drop, and then
it's gonna be
the narrative. Look, I can tell you guys, the narrative is already starting to change.
Yeah,
right. The narrative is now starting. More and more people are now starting to say, "Hang on a second, right? Where's the?" And venture capitalists and investors are ruthless. It's like, dude, I've given you $10 billion. Where's the profit? Right? And now they may not even make it to the IPO stage, because there's, you can't sell it.
Yeah, you can't prove that it's
Well,
going to work.
If you're not making enough revenue and your customer is saying, well, I'm sorry, mate, I can't see the return on my investment. And in fact, as we said, I think last week, Ford rehired 300 engineers that they sacked because they thought AI would do the job, right? Well, that, to me, that says it all.
Imagine being the guy to sack him. Imagine being that guy.
That would be you.
It would not be me.
You're the sacker.
Yeah, private credit. Private credit.
Sacker.
Unfortunately,
Jacob's a sacker for hire, by the way.
Yeah.
Absolutely ruthless.
Anyway, let's talk about a bit of mean reversion. So usually what happens over market cycles, right, is stocks do really well, commodities almost become irrelevant.
Yep.
And then there's a cycle where that changes and stocks kind of meander away and commodities catch up. It feels like we're in, and we spoke about this a bit, but it feels like we're in that transition period now.
Yeah.
Particularly with emerging markets having really low capes as well.
Yep.
So, and they're typically commodity countries.
Exactly.
So we could end up having this kind of crossover at some point.
Agreed.
Which is why we like commodities, and we have done for a few years now.
Yeah. I think we're at the start of a strong commodities. I won't say super cycle, but I certainly think we're in a bull market. And that's going to be, again, because valuation aside, where it's cheap, that commodities used to be, energy, I think might be energy. Energy used to be something like 6 to 8% of the S&P. And at the moment, it's about 2%.
Mm-hmm.
Right. So in other words, it'll grow.
It's out of favor.
So I think, everything lines up when you look at it and say, because of the geopolitics and trade, everybody's scrambling for resources.
Yeah.
And what we've done, and we talked about this in the new normal, a year or so ago, we're moving from efficiency to redundancy. Redundancy meaning there's, I've got 10 spare ones out the back just in case, right? Before that, what we'd say is, no, we don't need those 10 at the back because Japan can send it to us anytime, or China. Now we're saying, listen, things are going pear-shaped. We need to hold 10 or 20 of these things out the back, which costs money.
Yeah, I also think that developed markets have had a shock literally in the last 6 months with everything going on with America, and their economic output needs to increase. They need to increase their efficiencies and their GDP.
Absolutely.
Because America's gone, we're not looking after you anymore. You need to build your defensive infrastructure, all of that. And they've gone, oh, crap, if we can't rely on this export kind of friendly world, then we need to produce.
Absolutely.
So a lot of spending and a lot of economic output individually rather than relying on somebody else.
Well, see, Europe this week has Europe's woken up. Sorry, go on.
And just to finish on, and that just to loop it back to commodities will drive that.
Yes, absolutely. Well, you need commodities to make stuff.
Exactly.
Right?
Yeah.
But yes, Europe this week, and mainly last week, but also this week, Europe has finally agreed with the Americans that they got a problem with the Chinese, right? In terms of exports. The Chinese, I don't know if you guys have seen Chinese car exports. No. They've gone from something like 1 million pre-COVID to 12 million, right, in exports. And of course, they're just flattening Europe.
I thought they were trying to limit that.
No, well, that's what I mean. Europe is now saying, listen.
Aren't they slapping tariffs on them and stuff?
They're
still firing.
They're talking to China at the moment about basically they're trying to say to China, listen, you guys have got to come to the table and play fair. And the Chinese are just like, not interested.
Yeah, doesn't
now,
matter.
The Chinese market is shrinking.
Yeah,
right?
Every second car's a BYD or a JQ or a
they're exporting their heads off, right? And they refuse to stop subsidising or currency manipulation. So you can see we're going to have a shit fight, right? Because we're going to have to say, oh, okay, well, if you don't want to do that, that's no problem. All right. Like Donald Trump, they'll say, okay, it's 100% tariff.
Yeah. Well,
and if that doesn't work, it'll be 150.
You've said it before where if they've made 100 million cars, they've only got 20, and I'm using wrong numbers, but they've only got 20 million people to sell them to in China. So they've got 80 million cars left.
That's exactly right.
So they go and just subsidize the crap out of them.
Exactly. This is again where old guys like me have been through these cycles. This is what Japan did, right? Japan became super efficient. manipulated the currency, supported all their car industries, right? And the Americans in Reagan at that time said, okay, we'll stop being mass manufacturing. We'll get rid of, all of our brands. And of course, the Japanese went, fantastic. So the Japanese exported heaps of cars. Then in the 80s, the mid 80s, they had this thing called the Plaza Accord. But essentially what happened was the Yanks went to Japan and said, listen, you guys have got to stop this. So you either come and build plants in America or, we'll find ways to stop you exporting out of Japan. So the Japanese said, yeah, righto. So they started booming in and building car plants in America, right? And so this is, we dealt with the Japanese and now we've got the Chinese doing it.
Yeah, but the Chinese aren't playing ball.
So this is where this is why we're going to end up with an era of disruption, because if you look at the way that China is embedded in global supply chains, it's near nigh impossible. What the world has turned into, I was thinking about this during the week, and I'll put some diagrams up next week for the podcast. But what's happened is every country, not every country, but most countries have got a lock on something, right? So the Japanese have got these little niches, right, where they've got the best glass manufacturers, right? But China's got the best iPhone case manufacturer, and Germany is the best at the laser parts, right? And America's got the purest silicon, right? 95% of the silicon used in the world comes from quartz, comes from one mine, right? One mine for 95% of the world's content, right? So the problem we've got is if you say to me, well, stuff you, I'm not sending you the quartz. I say to you, all right, well, I'm not sending you the helium. And you say, all right, well, if I can't do that, I'm not sending you the chips.
Yeah.
And you say, yeah, well, I'm not sending you the rare earths. So you're in this position where everybody's knackered, right? Because we're all reliant on these specialist parts.
We have to work together, but everyone's fighting.
Yeah, that's the problem, Tom.
No,
right? It's like building a Boeing plane where there's 100 countries involved, but we're all holding each other to ransom. And the argument is, okay, well, bugger them. We'll make the wings here. It's like, we can't.
Yeah.
Or you say, well, we can do, but it'll take us 15 years.
Do you all want the bloody plane or not?
Yeah.
And it'll be crap. Well, that kind of squashes the idea that so most people, including Tom and I, who are probably under the age of 50, have only ever seen a market go up with 10, 12, 15% earnings every year.
Yeah. The globalized world, right?
Yeah. And moving to something like this is quite unfathomable for most people. But when you kind of out there doing some research into finding either a financial planner or someone looking to get some advice, I would always say, even like it doesn't have to be with us, but I would always say find someone that's been through both bull and bear market, proper bull and bear markets.
Yeah, the cycle,
and pick their brain on both, because if they're telling you markets only ever go up, they've only ever seen one market.
Yeah, well, that's like Korea, right? The young boys in Korea and Japan throwing all their money in the stock market. It's booming. But if you went in there and said to them, listen, fellas, you need to be a little bit cautious, because these things go down, mate, I'm telling you, you might as well talk to a wall.
Yeah, it definitely is.
Right? Because it just doesn't sink in. And that's why, I'm old enough, and I think I said a few months ago, it's only because I'm old that I've got the experience, right? And I go, oh yeah, I've seen this stuff before.
Yeah.
Right? Whereas I find most of the mainstream, most of the commentators are not as old as me. And so they haven't been through that part of it. And I might be overly cautious, but I've been through hey, we're making heaps of money. Oh my God, like I've just lost heaps of money, right? And it's really unpleasant.
Yeah, and having a strategy for both sides, like make
100%.
hay while the sun shines, but also cover it while it's raining.
Yeah.
Like you need to have both, otherwise you're actually buggered.
Yeah, absolutely.
So I think, even Tom and I have learned that. We started with cryptocurrency, and we've seen it go from $5,000 to $50,000 to $3,000, and it's like a really fast tracked way to go. Oh, it's all gone now.
Absolutely.
So like we've been quite luxurious, in a luxurious position to go through that, lose a lot of money, and then go, okay, now we need to actually do something.
Yeah.
Well,
we'll stop playing with 100 times leverage.
But see, Tom, that's what's happening now.
Yeah.
Right. The leveraged ETFs, the margin.
You can blow your account up so quick if it goes the wrong way.
I can tell you, the margin debt's now at 1.5 trillion, right? Leveraged ETFs and 0-day expiry options are absolutely killing it. And what it's doing is it's distorting the underlying market.
100%. And the other thing that most people don't realize is, especially if they're going to trade cryptocurrency markets or something like that, they might think they're safe because they have a stop loss. But if there's not enough liquidity there, it can skip past your stop loss level.
Absolutely.
Like, you can run up in the red.
And Tom, that usually happens because the volatility, like you were saying with the Korean market this week,
down, it never hits your trigger price.
Absolutely. Yeah. Like, you think, oh, well, I've got a margin of 10, I'm okay. And you wake up and it's down 25, right? And that's what happens because we're all dancing on one side of the boat, right? And the boat, can turn over really, really quickly.
Yeah. Well, we're going to have a bit more of an in-depth conversation for the premium members. I think, is it Monday next week? We've got a coaching call.
Yep.
So this will be out, and then we've got the coaching call that night. So if you want to jump on that, you can head to the website and
we'll talk about a few stocks.
We'll talk about some stocks.
We'll share the video because by the time you hear this, it will have happened. But if you sign up to premium in the meantime, you'll get the video anyway.
There you go.
Cool beans. All right, gents. Well,
last one. Can we just slip in? What's your edge?
Yeah.
I just want to say to people, be careful because stock markets can go nowhere for a long time, right? The other ones that go nowhere for a long time is property markets, right? So we haven't mentioned that, but property markets and stock markets, if you get a long enough timeline, it looks like it goes up. But, you're not investing from 1870 to 2026, right? And if we've got a little chart in there, you can see that from 2000 it took to 2014, right, to get your money back. From 1965 it took to 1982. Well, that's 17 years. Now that's half an investor's journey, right? And so I'm doing more work on this, and we'll present this over the next coming weeks because it's really important that people understand that the game has changed and the days of, hey, I'm going to make 200 grand in a quick capital gain are over, right? It's much more now about looking for income of, 8 or 9% in a yield scenario.
Yeah. I mean, even in stocks as well, not just property, like across the
Absolutely.
board, everything's in a bubble, right? So looking for yield across stocks, property, whether it's commercial or residential property, it's all the same. Where we're going, just take a breath. Like if you're expecting to buy in at a riverside kind of property in Noosa and then buy it for 3, sell it for 4 in 2 years, it's probably not going to be the case anymore. And there's more disconfirming. More people in the industry, brokers, real estate agents, are all saying the same thing. It's not just us. Just we were saying it 40 years ago.
Yeah, absolutely. It's just, I can't emphasize this enough. Things have been really crazy and it's been fun, right? But we're now in the 18th year of a bull market in the US, and every time in history, it doesn't end well, right? Whether it goes down quickly or it goes down slowly, it doesn't end well. And that's the main point, right? It's painful. I can tell you, there are opportunities, right? And we can talk about Indonesia and Brazil and Turkey much more than talking about the United States and Korea, where the capes are over 40.
Yeah.
Right.
But the underlying theme is asset allocation, like we say so often.
Absolutely.
You wouldn't go all in on anything right now.
No way.
Cool.
Righto.
All right.
Good one.
Thanks
Well
for
done.
listening.
Thank you.
Cheers, folks.